The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. Let's take a look at how Wall Street closed. And we have green on the screen as stocks stage a recovery rally after back-to-back losses as investors hope that an exemption for automakers to President Donald Trump's controversial tariffs open the floodgates for maybe even more concessions. So the Dow Jones Industrial Average rebounded 1.1% to 43,007, and that's around 485 points higher. The S&P 500 also up 1.1% to 5,842. The Nasdaq Composite climbed 1.5%, the outperformer. So let's check in now with Michelle Schneider. She is the Chief Strategist at the marketgauge Group. Michelle, thanks for joining us on the show. How are you doing?
I'm doing great, Ryan. Nice to hear from you.
Great to have you on as usual, Michelle. So we are having you on as we see a bit of a bounce on Wall Street. Walk us through what's driving this and how much momentum you're seeing behind this move.
Oh, as we all know by now, this has been a market that's been extremely volatile because it's very headline sensitive, and we have an administration that is very transparent about what they're thinking, and then that thought often gets changed, which has been making it somewhat chaotic for longer-term investors and probably a lot more fun for shorter-term investors because you can sort of follow the momentum of the day. But if we step back, essentially what we are experiencing right now is that a lot of the longer-term support that held for months and months and months has now become resistance. Even with today's move higher, the question remains, was this just a rally into resistance? And it could be a headline that comes out, or it could be from a more technical standpoint, you get selling coming back in, especially if we don't open, let's say, with any follow-through to the upside tomorrow. And that's kind of been the dictating thing here, is really essentially sell rallies. And in terms of buying dips, it's a little bit more cautious. But when you get your second green day, you're a little safer.
Yeah, let's talk about levels because we've been seeing quite a bit of movement, especially with the consumer sector in the news cycle these days. Walmart flagging slower growth. You've got the consumer index also warning about some signs of sluggishness. What are you seeing on the front when it comes to the consumer?
Well, that to me is the absolute key. We saw the peak in the tech stocks in July, and especially in the chip stocks. But really, we had a lot of promise yet for the consumer because there was a lot of reports that the consumer was still robust. But now we're seeing that flip. And not only did we hear these sort of reports from Target and Walmart, Best Buy crashed today after its earnings, what we're seeing is the whole retail sector under a lot more pressure than any other sector right now, which is scary because we have a GDP that's very dependent on the consumer. And if they do not feel confident that interest rates will go lower or inflation will come down, or they are going to have to pay much higher costs for goods that are being tariffed, then that backing up of spending will, I think, continue to haunt the market, and you'll get these pockets of rallies, but ultimately it means the economy is slowing down.
And you're tracking the consumer sector XRT, that's pretty much under some of the major moving averages you're tracking. So it does show that there is quite a bit of momentum on the downside.
Absolutely. And even a day like today where you did see a 500-point rally in the Dow, the XRT, the ETF that represents both consumer discretionary and consumer staples, that continued to grossly underperform. And that is not a sustainable situation. It's the same thing with the small caps. Even though they played a little bit of catch-up today, they're still really under major resistance. And while that continues, I think that you cannot be looking at, oh, this is a rally to buy and we're going to go to new highs, tariffs are going to go away, and Trump is going to capitulate on his very tough stand. He himself is saying there will be pain, and I think we need to take that literally.
Yeah, let's expand on that thought. There will be pain. So what's the pain going to look like? Because we are looking at trade wars just taking off to another level. You've got the reciprocal tariffs from China to some extent, and then it could go back and forth. Where is the pain going to be felt? What sort of price movements are you going to be looking out for?
Well, we're definitely going to feel pain, not just in the cost of goods, especially if we cannot come to some kind of negotiation with especially Mexico and Canada. And we did hear about the autos today. But still, we don't really know how that's all going to play out. So that's the obvious pain. The other pain behind that is the goal of these tariffs, if we want to go big picture, is for manufacturing and production to come back to the U.S., right? That's why we're hearing so much about obtaining critical minerals from other countries. That's why there's been so much focus on possible tax decreases here on people, looking for labor that's either American or somebody, the golden passport for $5 million. I mean, all these things really have to be put into place. It's kind of a gamble, if you want to really think about it, that the tariffs will lead to a more self-sustaining U.S. in terms of exports and imports. That's the gamble. But there's other things going on right now that cannot be dismissed. Conversations we've been having for a while, like our $365 trillion debt, or our $7 trillion worth of government spending, or our rates, which are still high, and we have a Treasury that owns $7 trillion in debt that has to refi this year at a much higher cost. So these are backing that up, which is why you're seeing gold continuing to go up. Now we're seeing other metals starting to go up because people are worried more about a stagflationary environment. Some people are even starting to use the R word, but I'm going to stick with stagflation for now.
Yeah, I'm also hearing some interesting ideas come out from Donald Trump these days. No income tax. Is that going to be a boost for the economy in terms of maybe shifting spending more money into the hands of consumers?
Well, I don't think, first of all, I mean, I'm not a political expert by any means, but I do not believe that that can be done through an executive order. I do believe that has to be passed through Congress when it comes to tax laws. So I know there's been talk about that and instead taxing anything that anybody buys, which is not on paper the worst idea, but it doesn't necessarily mean that it's going to work, especially if the cost of goods are already going up because of other types of inflationary factors like tariffs, for example. But he did talk about, in his State of the Union address, he did talk about cutting taxes. And so he didn't say zero, but he said cutting. And we have to look at that because he's touting how DOGE is cutting all these expenses, but the expenses are minimal compared to what the cost will be if all of a sudden the government isn't getting as much money from taxes. And so, it's been, everything right now I think is in a state of flux. Like I said, it's a gamble. He's hoping that he stimulates the economy. At the same time, he brings business back here. At the same time, he stops immigration. He's got a lot on his plate that he's hoping for, but we know that things may not always be that simple. And again, that's why I think you're seeing a massive amount of buying, particularly in the gold market, as that flight to safety in case.
All right, Michelle, talking about buying, let's look at your shopping list when it comes to stocks. And you've got IBM on the list. What's the story here? When you talk about AI, that's not the first thing that comes to mind.
No, it's more quantum computing. Also, obviously, the Dow has done very, very well over the course of time, even though it's come off from the highs. But IBM reported a very positive earnings report on the last quarter, and it gapped up in price after that. And it's been in this massive consolidation between 245 and 265, let's say. So it's really been trading in this sort of $20 range. And I think in spite of the huge down move that we've had over the last couple of weeks, it's sitting there. What that tells you is that they look like they have a solid balance sheet. Certainly pricing power is not going to impact them. And the strides that they're making in quantum computing, even though people say it's years out, is admirable. So that stock could, especially if conditions get better in the overall market, take off even further and go maybe to 300, 350. That's kind of what we're looking at as first targets.
All right, another play that you're looking out for in the tech sector of sorts, Adobe. What is the story behind this?
So Adobe is, by the way, made a nice move over the last couple of days. It's gone up about $10 off the lows. So that's good because it was going up yesterday, even when the market closed red, and of course got the follow through today. So this is what I'm saying. You know, some of these stocks that have been beat up, that have good bases, I think present the best opportunities rather than chasing the dips on things that have already made their move. You know, like the Nvidias of the world. But anyway, getting back to Adobe, so that's really AI and the premier space for Photoshop. They have a lot of different application software, if you will, that really helps for professionals who are doing design or photography or marketing, and it's heading more into the retail space as well. And I would keep my eye on that because I think you have a minimal risk in something like Adobe.
There are lots of applications with how AI could be used in many of their products. We've been in conversation with Michelle Schneider. She is the Chief Strategist at the MarketGauge Group. Michelle, thanks for your time, and always great chatting with you.
So nice to chat with you, too. See you next time. Thank you.
Catch you next time. Say Money FM 89.3.